Beyond reflecting market expectations, a yield curve inversion can also influence the real economy through the structure of the financial system itself. One of the most important mechanisms involves the banking sector. Commercial banks typically generate profits through what is known as maturity transformation. In simple terms, banks borrow short-term and lend long-term. They accept deposits at relatively low interest rates and then issue longer-term loans, such as mortgages or corporate loans, at higher rates. Under normal conditions, this model works well. If a bank's funding cost is around 3% and long-term loan rates are 5%, the bank earns roughly a 2% interest margin. But when the yield curve inverts, this business model can come under pressure. If short-term funding costs rise to 5% while long-term lending rates remain around 4%, banks may find that new loans generate little profit or even losses. In response, banks often become more cautious. They may tighten lending standards, reduce the volume of new loans, or raise borrowing costs for businesses and households. When credit supply contracts, business investment and consumer spending can slow. This tightening of financial conditions can ultimately weaken overall economic growth. In this way, yield curve inversion does not merely reflect economic expectations. It can also contribute to economic slowdown itself. Historical evidence supports this relationship. Before the bursting of the dot-com bubble in 2000, ahead of the global financial crisis in 2008, and again before the economic shock of 2020, the U.S. yield curve experienced clear inversions. Of course, the yield curve is not a perfect forecasting tool. Global capital flows, central bank quantitative easing, and structural changes in financial markets can all influence long-term interest rates and distort the shape of the curve. Nevertheless, among many macroeconomic indicators, yield curve inversion remains one of the most closely watched leading signals. For that reason, whenever recession risks begin to dominate market discussions, investors often turn first to the yield curve to see whether financial markets are already repricing the next stage of the economic cycle.